Hey guys, today we want to talk about a very niche media company, Entravision Communications Corporation. While the company's stock price has climbed more than 300% since the lows in 2020 when the market crashed due to the COVID-19 outbreak. So why is there still opportunity? Let's quickly take a look. Founded in 1996, Entravision has its roots in engaging the Latinos population in the United States. Since then, it has grown to become a diversified media, marketing, and technology company that continues to reach Latinos consumers in the US and other markets such as Mexico, Latin America, and Spain. Entravision is now considered one of the market leaders in Spanish language programming, with a wide coverage of television, radio, and digital networks reaching a growing Hispanic audience. As a matter of fact, the company's television networks, which is also its key profit drivers, commands a dominant share of 58% in the markets it is operating in. Similarly, its radio stations hold mostly number 1 or 2 Spanish language market share in key time slots of the markets it is operating in. Long story short, despite Entravision's market leader position of its TV and radio stations, its share price has been declining over the past few years. This is because the company had been struggling with its legacy advertising business in TV and radio as observed from the general revenue decline from 2017 to 2019. On the other hand, the effort to grow its digital arm hasn't been positive as well, as we saw a 15% fall in revenue in the digital segment from 2018 to 2019. The situation is made worse from the outbreak of the pandemic, causing the company's share price to fall to less than $1.50 a share. This has created a deep value investment opportunity back in the 2020 market correction. To cope with the falling advertising revenue in its TV and radio businesses, the company has cut substantial expenses in its TV and radio segments. The cost savings come mainly in reducing direct operating expenses as well as the selling, general and administrative expenses. On a side note, understand that 2020 was the US presidential election year, hence the advertising revenue for TV and radio was lifted up slightly by the year-round campaigns. Hence, moving forward, we shouldn't see this portion of the ads revenue for its TV and radio businesses. As for improving its top line, Entravision has made an acquisition of the majority stake in Cineros Interactive in October 2020 to boost the company's effort in building its digital business. As a result, you can see the significant 108% increase of its digital segment's revenue from 2019 to 2020, and Cineros Interactive only contributed to one quarter of Entravision's fiscal year 2020 results. While it was estimated that Cineros could add about $200 million to Entravision's top line on an annual basis, based on the first quarter 2021's results, I would say that it should add more than $300 million on an annual basis instead. To better understand to what extent Cisneros' business affects Entravision's operating results, let's take a look at Entravision's latest first quarter 2021 segment information. Observe that the digital segment now contributes a much larger portion of about 68% to the company's revenue in the first quarter of 2021 compared to just 21% back in first quarter 2020. However, even though the digital business now contributes a substantial portion to the top line, it is only contributing $4.3 million or 23% to the segment's operating profit. The TV segment still makes up the majority, 70% of the group's operating profit, and finally, its radio segment contributes the remaining 7%. The reason why Entravision can go around building new business opportunities, such as the acquisition of Cineros Interactive, lies in its strong balance sheet and liquidity position. As at the end of March 2021, the company has about $166 million of cash and cash equivalents and a debt of $215 million, meaning net debt stands at only $49 million. With more than $30 million in free cash flow in the pandemic-affected 2021, the company shouldn't have any issue to service its debt in the near term. Just for a gauge, Entravision registered a net income of $5.4 million or 6 cents earnings per share for first quarter of 2021. Hence, I think the consensus estimate of the company's earnings per share for the full year of 2021 at 37 cents a share is reasonable. At the current share price in the $6.60 range and a forward earnings per share estimate of 37 cents, this will yield a forward price to earnings ratio of 17.8. With the tailwind of digital advertising spending projected to grow at a compounded annual growth rate of 13% for the next 5 years, I think the forward PE of less than 20 is still considerably low given the general high valuations we see in the market today. And I think that growing at 13% in digital advertising is achievable, with Cineros' digital business already growing at a very high growth rate year on year. Although we are not able to use this 13% as a blanket growth rate for the whole company, since the majority of the operating profit is still generated from the TV segment, we can already see that the digital arm will contribute to an increasing amount to the group's top line. Hence, long-term wise, we should expect the company's growth to more or less align to that of the digital ad spending growth. If the company's digital business continue to grow aggressively and say the bottom line just grows at 13% per annum for the next 5 years, while the PE multiple expands to just 20, we can expect Entravision's share price to 2x to more than $13 a share in 5 years' time. Another tailwind will be that the US Latino population is estimated to increase faster than the general US population, resulting in an increasing percentage representation of the Latino ethnic group in the decades to come. Therefore, Entravision's focus on providing media-related services to this niche group of community will stand to benefit from this tailwind. To sum it up, I think Entravision provides an opportunity to invest in the growth of digital ad spending at an attractive valuation with a forward PE of 17.8 as discussed earlier, and that's despite the run-up in share price to more than 300% since the pandemic-induced market correction in 2020. So I will be adding some positions to my portfolio and possibly add more if the market corrects. While there remain risks of how much the company's legacy business in TV and radio will deteriorate, we can see that the management is really realigning the company's strategic direction towards the digital channel. Also, with Entravision's strategic focus and leading market position in providing news and entertainment to the Hispanic community, the company will be well positioned to leverage on this extensive outreach to grow its advertising business through the digital channels moving forward. Let me know your thoughts on this and share with us in the comment below, and remember to subscribe to our channel so that you can be informed once our next investing tip is out. In the meantime, check out the recommended videos here to continue learning so that you can make better investment decisions. Keep learning and happy investing, and we will see you soon.